kid. You don't have to rationalize everything.
All right, I will buy it. It'll be good for the economy.
Topic number 2, national income accounts. First, let's define that. National income and product accounts, or national accounts, keep track of the flows of money among different sectors of the economy. That means we'll be discussing circular flow, GDP, and real versus nominal GDP.
The national accounts owe their creation to the Great Depression. In response to the perceived lack of information, the Department of Commerce commissioned Simon Kuznets, a young Russian-born economist, to develop a set of national income accounts. Kuznets later won a Nobel Prize for his work. The federal government began issuing statements of GDP and gross national product in 1942. National income accounting, since its invention in the United States, has then become an economic tool of analysis and policy-making around the world. Beginning with circular flow, the easiest way to discuss it is not actually telling you what it is, but showing you. There are two versions, simplified and expanded. Though simplified gives you the important ideas, the meat and potatoes, expanded implies exactly what it is, everything else, the garnish, the roles, and most importantly, the government. So let's take a simplified look at expanded circular flow. The best way to understand circular flow is to simplify it to its most basic form, a circle. Many things are circles, and I know this is an extremely extended metaphor, but trust me, there's a point. We have oranges, wheels, balloons, balls, and my personal favorite, cookies. There are 4 basic ingredients to a chocolate chip cookie: flour, sugar, eggs, and butter. Likewise, there are 4 basic ingredients to the circular flow diagram: households, factor markets, product markets, and firms. Households are a person or group of people who share income. Factor markets are where resources like capital and labor are bought and sold by firms, who use these resources to make the goods and services sold on product markets, where they will be bought by households. But the most important ingredient to this recipe are the chocolate chips. Unfortunately, we ate all of them, but we still have the central element of a complex circular flow diagram: the government. The government spends money just like you and me. Unfortunately, they also take money from you and me, so we cannot buy as many cookies as we'd like. Taxes, or required payments to the government, are how the government gets money, which contributes to tax revenue, the total amount of money the government receives from taxes.
Surprise, surprise. You thought you were taking a social studies class, weren't you?
Right? Wrong!
Time for some math, so let's go back to households. The money households have can be calculated as their disposable income. That's income plus government transfers, payments that the government makes to individuals without expecting a good or service in return, minus taxes, is the total amount of household income valuable to spend on consumption. Wait, what's this? Is it a secret ingredient? Nutmeg, white chocolate, or raisins? No, it's financial markets. Financial markets describe when people channel private savings into investment spending and government borrowing. Let's define those two terms. Government borrowing, the amount of funds borrowed by the government in financial markets. Number 2, investment spending, spending on new productive physical capital such as machinery and structures, on changes in inventories. Inventories meaning a quantity of how much a firm is making of a product that they will later sell on the product market. So an example would be a company like Nabisco spending money on more machinery to have better cookie output. But to continue that, circular flow is really just something that's not unique to our country. Other countries make cookies, among other things. Let's bring another circle into the picture: the world. Exports and imports have a say in this too, meaning what we send out to other countries that buy from us and what we buy from other countries who send out to us. I know it's confusing, but I promise it's very clear. It'll all come around soon. Okay, sorry for the circle metaphors, but that's just the way the cookie crumbles with me. So let's pass it to Caitlin.
I'm going to be covering the second tool of national income accounting, which is gross domestic product. GDP is defined as the dollar value of all final goods and services produced by a country during a given year. But we have to be careful because that's a very specific description, and only final goods and services produced domestically count towards GDP, which means that secondhand purchases, the purchasing of stocks and bonds, purchases of intermediate goods, purchases on the black market, and imports all do not count towards GDP. The most important use of GDP is to measure the size of the economy, providing us a scale by which to compare the economic performance of one country to another country or from one year to another year. However, there are limitations to using GDP as a measure of economic health. One being that population size does distort GDP. Countries with higher populations have a larger workforce and are able to produce a higher quantity of final goods and services than countries with smaller populations and smaller labor forces. One way to account for the difference in population size is to look at GDP per capita. GDP per capita is the value of GDP divided by the population size, and by looking at GDP per capita, we can look at the average amount of output per person in a country, which is a much more stronger indicator of a country's ability to produce goods and services. Hi guys, we're going to review what we just learned by going over what counts towards GDP and what does not. First up, we have the family's purchase of a second-hand car. This is not counted towards GDP because this car was already counted towards GDP when it was sold brand new, and we don't want to count it twice. So we're going to give this an NC for not counted. Second up, we have a farmer's purchase of a new tractor. This is the sale of a final good, so we are going to count this towards GDP. So we're going to give it a C for counted. Alright, and third, we have a barber cutting his own hair. Now he's not selling this for a value amount, he's just doing it for himself, so we're not going to count this towards GDP. So we're going to give this an NC for not counted. And then fourth, we have Chevrolet's purchase of tires to put on the trucks they manufacture. Now, this is an input to the final product, which is the truck, and if you remember, intermediate goods are not counted towards GDP, so we're going to give this an NC for not counted. Fourth, we have a barber's income from cutting hair. Now this is the income from a sale of a service, so this is counted towards GDP. So we're going to give this a C for counted. And then finally, income received from the sale of Nike stock. If you remember, the sale of stocks and bonds is never counted towards GDP, so we're going to give this an NC for not counted. Alright, now that we know the purpose of GDP and what it is composed of, we can learn the three methods of calculating GDP. They are the income approach, the expenditure approach, and the value-added approach.
The income approach uses the sum of all total factor payments made to households, including rent, wages, interest, and profit. The expenditure approach adds up aggregate spending on domestically produced final goods and services with the formula consumer spending plus investment spending plus government spending plus net exports. And net exports can be calculated using the following formula: exports minus imports. The final approach is the value-added approach, which surveys firms and adds up each contribution the firm makes to the final goods and services produced in a country. The most popular method of measuring GDP would be the expenditure approach.
Now it's time for another GDP lesson checkpoint, expenditure approach. I'm going to read 5 examples on the board, and together we're going to label them either C for consumer spending, I for investment spending, G for government spending, X for exports or imports, and NC if it is not counted toward GDP. Feel free to take out a scrap piece of paper and pause the video if you'd like. Number 1. An accountant pays a tailor $175 to sew a new suit for her. This is C, consumer spending. Number 2. R.J. Reynolds buys control over the company Nabisco. I. This is investment spending. 3. You buy a new luxury car that was made in Germany. This is X. This is an import. 4. Parents work hard caring for their 2 children. NC. This is not counted towards GDP. And 5. The government makes a $300 Social Security payment to a retired person. This is G for government spending.
We have to be careful using GDP numbers, especially when making comparisons over time. That's because GDP numbers usually increase each year, but it can represent increases in the price level of goods and services rather than an increase in actual aggregate output. To measure an economy's growth with accuracy, we need a measure of aggregate output that accounts for these fluctuations in the price level. To measure output independently of inflation, we must use real GDP. Real GDP is the total value of all final goods and services produced in an economy during a given year, calculated as if the price level had stayed constant to a given base year. The alternative to real GDP is nominal GDP. Nominal GDP is gross domestic product at current prices, meaning that the GDP is calculated using the price level for the same year in which those goods and services were produced. Here's a simple example of real versus nominal GDP. We're going to pretend that this economy only produces two kinds of goods, apples and oranges. Notice that this chart gives us the quantity of apples and oranges produced each year, as well as the price levels they're sold at during that year. Remember that nominal GDP is GDP at the current price level, so to find the nominal GDP of the year 2021 and 2020, we simply have to find the value of all apples and oranges sold during that year. I took the liberty of calculating the nominal GDP for us and found that there was a $500 increase from the year 2020 to the year 2021. But I promised it wasn't a full $500 increase in aggregate output. A lot of this increase in nominal GDP was due to the increasing price levels of apples and oranges. If you want to find the actual increase in aggregate output, you want to use a real GDP. To find the real GDP of the year 2021, you want to take the quantity of goods produced in 2021 and multiply it by their price level in the base year. And since our base year is 2020, we're going to take 2,200 apples and multiply it by 25 cents per apple, and 1,200 oranges and multiply it by 50 cents per orange. This is going to give us a real GDP of $1,150 for the year 2021.